A company's profitability is first and foremost its ability to generate a profit, meaning that its income, its sales are greater than the expenses, the costs it has incurred to satisfy its customers. And a company must be profitable simply to ensure its long-term survival by maintaining its production capital, repaying its loans, and providing sufficient returns on the capital invested by its shareholders. But profit alone is not enough to fully grasp this concept. In fact, to achieve this, the company must also employ material and financial resources. In this context, measuring profitability involves relating a performance indicator, such as profit, to a resource indicator. There are three types of profitability: operating profitability, or ROI, return on investment, which involves relating an operating result indicator to the tangible and intangible resources invested in operation. Economic profitability, or ROA, return on assets, which involves relating net income to the total assets invested in the company, whether operational or not. And finally, financial profitability, or ROE, return on equity, which involves relating net income to the resources invested by shareholders, that is, the equity. The percentages obtained have little meaning on their own because the nature of the company's activities heavily influences the calculation. An industrial company requires far more resources than a service company without necessarily generating more surplus. To understand and analyze these ratios, it is important, on the one hand, to assess how they evolve over time, whether there is improvement or deterioration, and, on the other hand, to compare them with those of competitors who face the same structural constraints in terms of resources and market. Then, when a deterioration is detected, or when performance is shown to be lower compared to competitors, it is necessary to identify the reasons for this. And the potential list of these reasons is very extensive. Insufficient productivity, an investment policy that is poorly calibrated, either too high or too low, poor control over certain costs, excessively high financial charges, and so on. The profitability measured by these ratios merely summarizes both the strengths and weaknesses of the company, and it must be interpreted with balance and perspective in order to propose remedial measures if necessary.